All right, so we had another crazy jobs report last Friday. That was after that crazy low ADP payroll report that we had last week too. So it's kind of weird. As of last week, it was like jobs to the moon, rates to the moon, everything's going crazy, right? Well, treasuries have pulled back some, thankfully. The 10-year treasury last week was around 482 at the high, and today it is at 463. So that's good news for people if they need to lock in or if they hadn't locked in last week. Now, the 2-year treasury is still inverted. It has pulled back some, though, to 496. Now, why are treasuries pulling back? Well, part of the reason has to do with the attack in Israel over the weekend. So markets are reacting to that. And the other part of that is that, the market's not really seeing another rate hike in our futures. They think that the Fed is probably done hiking. So it kind of depends on some of the news that's going to be coming out over the next couple of weeks. Of course, we still have some more CPI and PPI reports and things like that to look at. Hopefully, if those numbers don't come in as we expected, or they do, we could possibly still have another hike. That remains to be seen. Now let's talk about these jobs because something really strange is happening. I am no conspiracy theorist, definitely not. And let's just say that jobs are a lagging indicator. They're not a leading indicator. But none of that matters when the job market throws up these crazy numbers, right? This jobs thing just feels really weird. All year, we have downward revisions. And just as everyone's starting to catch on to this game, suddenly the revision is a huge upward gain. Very strange. That said, a strong jobs number doesn't necessarily mean we have a strong economy. So during the last 9 cycles, in fact, monthly non-farm payrolls had huge numbers, like over 200,000, heading into the final hike. Sometimes the highest number also came the month of the last hike. In December 2018, for example, non-farm payroll was 248,000. That was the final hike before they cut rates just 7 months later. In March 2006, it was 310,000. Within the 24 months after that, rates dropped 2.75%. So in terms of rate hikes, you might have thought that the odds of a hike spiked after last week's jobs report, but it doesn't necessarily mean that. November 1st is still showing just a 27% probability of a rate hike. Looking out to the December meeting, the odds increased to 42%. Not exactly the sort of response you'd expect after this crazy high jobs report, right? Remember, if the Fed believes it's going to be hiking at the next meeting, the Fed speak will ramp up aggressively in the next few weeks. The Fed's ideal outcome is that by 2:30 on November 1st, there is a zero market reaction. That means that they signaled appropriately. They'll talk up a hike, driving market odds north of 60% ahead of the meeting. The Fed goes quiet the week before the meeting, so that means they have about 2 weeks to signal. So if Fed speak doesn't drive up odds of a hike before the last week of October, they won't be hiking. The Wells Econ team made headlines last week when they called for a 2.25% rate cuts in 2024, putting the Fed funds rate somewhere around 3 to 3.5%. I know that seems out of the question at this point. A lot of people think we might not even be cutting next year at all, but this pattern repeats itself every cycle. I've talked about this before. The Fed says they have a few hikes left in them, but then they don't hike. They say they aren't cutting, but then they do. So in December 2018, the Fed said it would hike 2 more times in 2019, pushing the Fed funds rate to 3%. Instead, Fed funds finished 2019 at 1%. That's a full 2% below what they expected. Now, I don't know if we'll get to 3% in 2024, but I do know that the cuts are going to catch us and the Fed by surprise. So we have another CPI reading this week, and core CPI peaked 1 year ago at 6.6%. Last month, it was 4.3%, and this month is projected to come in at 4.1%. But more importantly, the monthly data matters more. 2021 in Q4, core CPI month over month was 0.7%, 0.6%, 0.7%. That annualizes to 8%. CPI peaked at 9.1% just 6 months later. If it comes in Thursday as expected, the last 3 months would be 0.2, 0.3, and 0.3, which annualizes to 2.7%. Now, I get it. That's still above the target, but with enough downward momentum to be patient and wait for the hikes to work their way through the system. So as long as that monthly number doesn't increase to 0.4 or 0.5%, I don't think the Fed hikes. If it does, however, the inflation hawks still have plenty of ammo to keep hiking. Now, let's go back to the banks, right? The Fed keeps talking about how healthy the banking system is. Well, the FDIC's most recent quarterly report revealed that banks had the largest unrealized losses of Treasury holdings ever. So remember, the banks don't have to mark-to-market treasuries, but that didn't stop SVB from going under after the market ran the math and determined that it would be upside down if it did have to mark-to-market treasuries. So the Fed rolled out a one-year program in March called the Bank Term Funding Program. Banks stopped borrowing from the discount window and switched to the new program. They post treasuries to the Fed, and the Fed gives them 100 cents on the dollar rather than 80 cents on the dollar. Now, the more the rates climb, the more those bonds drop in value. So this gives banks more incentive to post the treasuries to the Fed and take face value cash. SVB probably would have survived if this program existed in February. That would have been nice for them, right? But the Fed's basically buying banks more time to figure out their balance sheets and avoid a similar fate. So a couple of thoughts here. If everything is fine in the banking system, why is this program even in existence? And what happens in March 2024 when the program ends and banks have to give back the cash? And then what does it mean if the Fed extends the program? Does that still mean that the banking system is sound? Just some things to think about. Now, there is one other way, rather than extending the program, to lessen those losses on bonds. What do you think that might be? That might be to cut rates. So basically, if the Fed starts cutting rates, then bond prices will go back up and the banks won't have nearly as big of a loss on their balance sheet. So that is one way to fix the problem. So if you are a conspiracy theorist, I have found no information to back this up. I have found no information to back up that rates drop during an election year. So I'm not saying that's going to happen. However, there are some things that are happening in the economy with banking and with, debt and those kinds of things that might be helpful for the Fed to start cutting rates. So whether that happens in 2024, early 2024, late 2024, or even 2025, none of us can be certain, but we can all say it's going to happen at some point. So we're going to keep watching the data as it comes out over the next few weeks to see what it's looking like. But the good news is I think every time that the Fed says that they have more rate hikes in them, they usually don't end up finishing the last one or two. So I think we are at that place now, but let's see how the information comes out. Now, in terms of the real estate market, things got pretty quiet while the treasuries were running away from us. There's still some deals to be done. And the good news is on the residential side that Fannie Mae is coming out with a new program where you can buy a 4-unit and put just 5% down. So you guys should call Kenny about that. I believe it has to be owner occupied, but that is really, really good news. And I think that will get some real estate moving again. So if you are in the market for to do like a house hack, or you want to get your first property, this could be a really cool program. And I believe it's coming out in the middle of November. So call Kenny for those updates. As I have mentioned in every previous video, if you got a rate quote from me last week or from anybody else last week, definitely get that updated this week because things are moving and they're moving quick. Have a great week, you guys. I really appreciate all your support and listening to my videos every week. Let me know if there's anything else that you want to talk about, and you can always give me a ring or come by the office.